Hello, and welcome to the Candlestick Forum Bullish Engulfing Signal Training Program. My name is Steve Bigelow. I have been working with candlestick analysis for a little over 25 years now. What I discovered when I first started learning candlestick signals was that most people thought there was too many of them and they didn't always work. I came back to a very simple premise, that if they didn't work, we wouldn't be looking at them 400 years later after the Japanese rice traders developed them. And there was quite a number of the 50 or 60 signals that didn't occur often enough to take the time and effort to try to learn them. What I have done is I have boiled down the 12 major signals to very easy to recognize and understandable on how to use them for learning how to use candlestick signals effectively. In learning how to use the 12 major signals correctly, you will understand not only what the psychology is of investment sentiment at reversals, but you'll have an understanding of what's going on in the whole investment market as these price trends change. This gives you kind of an insight that would give you the same knowledge as seasoned, experienced investors. What makes a stock price move, and we're going to use the terminology stock price in our evaluations, even though candlestick analysis is just as effective on commodities, currencies, tulip bulbs, anything that has fear and greed in it. What makes a stock price or markets move up or down? It is not fundamentals. It is the perception of fundamentals. And this is the most powerful aspect of candlestick analysis. The signals are the result of the cumulative knowledge of all the participants that have bought or sold that stock or any trading entity during that particular time frame. In candlestick analysis, the time frame can be a 1 minute, 5 minute, 10-minute chart, or a daily, weekly, or monthly chart. The signals created are still the accumulative knowledge of everybody buying and selling during that specific time frame. And let's take a quick look at the basics, which are very simple for analyzing candlestick formulas. The Japanese rice traders added an important element in analyzing charts. Essentially, they boxed in the open, where they signified an open, and if the open closed higher than the trading closed higher than the open, it created a white candle. If it opened here and closed below where it opened, it created a dark candle. That did not necessarily mean that the price of the trading entity was up or down for the day. So in today's training, we are going to work on the bullish engulfing, one of the major signals out of the 12 major signals. But before we start, let's examine some of the other indicators on the chart that make candlestick signals much more effective. As you can see, the candlestick chart is not a very cluttered chart. The indexes, or the indicators that we have on the chart, such as this chart for Apple Computer, are very simple. We use the 200 simple moving average, the 50-day simple moving average, and the gray is the 20-day simple moving average. The reason we have these on the charts is that every major money manager around the world uses these moving averages to make their decisions as far as getting in or getting out of their positions. We also have the ones that we have developed with Rick Sadler being the developer of what we call the T-line. That is the 8 exponential moving average. This is very, very accurate as far as maintaining a trend, with a very simple concept that if you see a candlestick buy signal and a close above the T-line, you stay in it until you see a candlestick sell signal and a close back below the T-line. We also use stochastics to indicate our overbought or oversold condition. We use slow stochastics with a 12-3-3 combination. If the stochastics are in the overbought condition, obviously, which is above 80, we're looking for sell signals. If the stochastics are in the oversold area below 20, we start looking for buy signals. The first step for each candlestick signal is basically recognizing the signal. The bullish engulfing signal has very simple parameters. The bullish engulfing signal is formed when it opens below the previous day's close of the dark candle, which is usually at the end of the downtrend, and it closes above the previous day's open. The body of this candle completely engulfs the body of this candle. Not necessarily the shadows, just the body. However, if it doesn't close the body or the shadows, it makes it that much stronger that the bears have gotten out of the way and the bulls are now taking control. The bullish engulfing signal is very easy to recognize. The body completely engulfs the previous day's body, usually found in the oversold area and at the end of a downtrend. The signal is going to work most effectively when it's found when your stochastics are again below 20 in the oversold area. Just common sense in all candlestick analysis is if you see a candlestick buy signal in an oversold condition, the probability is that there's been a reversal and you're going to start an uptrend. Remember, the stochastics are a slow 12-3-3. That's not anything that is set in stone. I use that mostly for my swing trading as well as day trading. Longer term investors might want to use 14-5-5 just to keep the wiggles out of the trend. We also try to identify other parameters or indicators that show the probabilities of a reversal has occurred. For example, a bullish engulfing signal right at the same area that the trend bottomed out before has a much stronger probability that it's now creating a double bottom, which usually implies that the next trend is going to be fairly strong. And other factors which are true with all candlestick signals is that the bigger the signal is, the more compelling. There's been a change of investor sentiment and the trend has reversed. Knowing the expected result of a candlestick reversal signal, it also allows candlestick investors to take advantage of investment strategies that dramatically improve the probabilities of being in the correct trade at the correct time. For example, once we see a bullish engulfing signal, maybe forming on a double bottom, what do we want to see the bulls doing afterwards? We want to see that the bulls are still participating. We don't want to see them gapping it way down here. That tells us the bulls aren't there. The implication is that if we see a bullish engulfing signal, we should still be seeing the bullish participation afterwards, which gives us a high probability we're in an uptrend. And if we see a candlestick bullish engulfing signal in the oversold area and they gap it up the next day, that tells us not only have we had a reversal, but the uptrend is going to be fairly strong because they are very anxious to be getting into this position. That was the evidence that we were given by the gap up in price. This tells us there's great enthusiasm coming into the price of this stock, which is exactly what we want to see after seeing a reversal signal at the bottom. Most money managers will tell their investors to stay away from gaps because a gap doesn't allow you to understand what's going on. A candlestick signal followed by a gap is your best friend. You'll make very strong profits from that move. On the other hand, what happens if the price does open lower after a bullish engulfing signal? Very simple. You put your price or stop, buy stop right here, one tick above the previous day's close. If it opens lower and the bulls come back up through that level, they're creating obviously another bullish candle. and it tells us the bulls are still there. A bullish engulfing signal in an oversold condition, stochastics coming up, we don't need to buy it until we see that the bulls are still participating, and the T-line will also be a very effective parameter of when to get into positions. Once again, the bigger the signal, the more compelling the uptrend or the reversal. Notice how they opened it lower the next day, right on the T-line. The T-line is a very effective indicator, a very accurate indicator to tell us how long to stay in a position. So if we know the parameters are already set up, a bullish engulfing signal in the oversold area, just about ready to break out through a downtrending channel. If we see it open, we want to buy it. As soon as it comes back up through the previous day's open, it tells us the bulls are still there and they're probably taking it higher. And another factor is if we see a bullish engulfing signal followed by bullish confirmation the next day, even more confirmation is that they can close it above the T-line. This tells us we are now in a positive uptrend until we see a sell signal and a close below the T-line. Again, stochastics in the oversold area starting to come up. Bullish open, we want to be buying, and then a close above the T-line. There's often questions, if it opens positive, isn't there a possibility it can sell off? Yes. And we have some very simple stop loss parameters that we'll get to that show us when to be right back out of a trade. And the bigger the gap up after a bullish engulfing signal, the higher the probability your uptrend is going to be. Also note that when they gapped it up through the T-line and the 50, making those resistance levels non-resistance levels anymore. The open used the T-line as support and immediately started trading from there. A bullish engulfing signal in the oversold area is also a prelude to what we call a doji sandwich. It is not unusual to see a bullish engulfing signal followed by a doji, and we know the simple rule of a doji. It's going to move in the direction of how they open it after a doji. So if it opens positive, you can be a buyer because we know the probabilities are that there's still going to be some strong buy-in after that signal. Also, we know that the bigger the signal, the more compelling the uptrend is. We also know dojis are indecisive trading. Here we've got the message that the uptrend has started because of a huge bullish engulfing signal coming up through the T-line. First major resistance at the 50. Pulls back right to the T-line. What starts a new uptrend? A doji after a after a doji signal. And then bullish confirmation the next day. This whole setup right here told us we've hit bottom and we're starting that strong uptrend. The more indications you can apply to each major signal, the higher the probability a reversal has occurred. For example, nice bullish engulfing signal right on the 50-day moving average. Also, notice that it closed back up above the T-line. Took it a little while to get started. There wasn't any real confirmation to buy until we got over here after the inverted hammer. However, you can come back and look at this all saying this is where the reversal was starting. All signals aren't going to immediately start an uptrend, but the combination of what's going on between the buyers and the sellers creating signals is that much more compelling when you can see that the bulls were starting to take control, there's still some profit taking, and the bulls took control again. And the Japanese rice traders developed very simple common sense applications for where stop losses should be placed. The bullish engulfing signal has the most obvious. The logic behind candlestick stop losses is very simple. The Japanese rice traders say if this was the candle that told you that the bulls were starting to take control, then where should the trading not close? it shouldn't close back below the halfway point of this candle. Otherwise, it's telling you that the bears are back in control. And obviously, you don't want to be in a bullish position when you see the bears are still in control. This is also based on, or can be applied to all the other major signals. There will be points that show where the obvious spot is to be back out of a trade if it closes more than halfway down a particular candle. And the corollary to that is, because there is so much emphasis put on the open and the close, you can have one stop loss where you should not see it close more than halfway down a candle. But also, if the bulls are in control after a bullish engulfing signal, then they should not be able to trade it back down below the low or the open of that bullish candle. If the bears can trade it back down below that point, that tells you there's not much selling or much buying in the trend right now. Get out of the position. So 2 stop losses. A halfway point, it shouldn't close more than halfway down the candle, but intraday, it shouldn't trade back below the bottom or the open of that candle. And if you're ready to execute a trade based upon a bullish candlestick signal, where should it not open? Should not open down near the lower end of the candle, or the signal that told us the bulls were taken in control. What would be expected would be a positive open, and especially hopeful that it would close above the T line. If they open it at the lower end of that candle and start trading it down, that tells you the bears are still there. You might not want to get into this position right away. As we can see, the result of this one was positive, but at this point, that was not the point to get into that trade. Again, the halfway point of this candle is very crucial as far as what the Japanese rice traders expect a price move to do. Bullish engulfing signal followed by a bullish open. If that executed a trade, it shouldn't close more than halfway down this candle. The halfway point is an extremely important area or point of trading for the Japanese rice traders. This is a completely different concept than what most money managers will tell you. They will tell you to take your losses after a 3%, 5%, 6%, 12%, whatever percentage rate they deem is important, that you shouldn't lose any more than that on a trade. The market doesn't give a hoot where you bought. It's where it happened in the trend that is most important. Entry strategies and stop loss strategies are very important as far as what is the action of the price the next day. Some positions that are recommended may not execute because they open and immediately trade down. That might not be the time to be buying this signal. It might be here that is more crucial for getting into a positive trade. Identifying signals at important support levels or resistance levels is extremely important as far as adding credibility to the signal. We will discover this in some of the following examples, that if you can add as many parameters for being in a positive trade at the signal time or because of the signal, it just improves the probabilities of being in the right trade at the right time. As can be seen in this illustration, a nice bullish engulfing signal occurred right at the 50-day moving average, and then was able to close above the T line. Got to remember, the benefit of candlestick analysis is that it shows you what's going on in investor sentiment exactly at the point in time that it's happening. So it can be logical to think that there's lots of reasons for money managers to be buying based upon this is where their buy area was, or they could see that it was supporting at the 50. We can see that immediately so we understand, using the graphic depiction of what's going on in investor sentiment, that a lot of big buyers are coming in right at the 50-day moving average. It's time to buy on confirmation. The signal and the T-line make for a highly efficient trend identification process. Bullish engulfing signal right on the 50-day moving average. What do we want to see occur the next day? We want to see the bulls are still there. You can be buying, and as long as it closes above the T-line after a bullish signal, the probabilities are now pretty strong that you're in an uptrend as long as you stay above the T-line. There'll be even times where the price will support at major resistance levels, or potential resistance levels, like the 200-day moving average, as well as the T-line. When it's time to buy becomes much more evident if you know the facets of the other candlestick signals. For example, an inverted hammer in the oversold area acting as a bullish harami. An inverted hammer signal, a bullish harami. A bullish harami tells us the selling has stopped, followed the next day by a bullish engulfing signal. This is an extremely high probability trade, especially after an inverted hammer. We want to be buying on next positive trading. When you start adding things together, it just improves the probabilities of being in the right trade at the right time. It becomes clearly evident that this bullish engulfing signal is also supporting right at the 50-day moving average. And remember, the bigger the signal, the higher the probability that we're starting to head up. Also, notice that it closed above the T-line. And some flat trading that ends up with a bullish engulfing signal, bringing you up above the T-line, is usually the indication that's going to be the kickoff, or that's the time to start watching for further buying. In this case, that little gap up confirmed that this bottoming action had now been completed with seeing the bullish engulfing signal and then further buying after that. But very simply, a bullish engulfing signal forming right on a support level and closing above the T-line usually will be the indication that this is a change of investor sentiment. Look for upside from this level. In this case, the bullish engulfing signal confirming the inverted hammer signal and closing above the T-line with stochastics in the oversold area is high evidence that you're going to be in an uptrend. Remember, this doesn't matter whether this is happening on a 1-minute chart, a 5-minute chart, a 10-minute chart, a daily chart, or a monthly chart. Investor sentiment is going to create the same patterns no matter what the time frame. Another major signal or pattern is what we call the belt hold. Belt hold is when they gap it down way below the trading range and bring it back up into it. It can create a variation or a multiple number of signals. In this case, it was a bullish engulfing signal. The rationale behind this being a very strong signal is that if they've gapped it down after a series of selling, that's usually the last gasp sellers just saying, get me out of this. And then, as you can see, once that selling is done, the bulls are now taking control, which means there's very little selling left. The bulls, any bullish trading will create a good positive uptrend from that point. And essentially what the bullish engulfing signal is telling us is after a few days of indecisive trading right here on a major support level, they finally made up their minds what to do, which was obviously they started to go bullish. This also makes for a very easy entry strategy. If it closes right on the T-line, what do we anticipate to confirm a bullish engulfing signal? A positive trading the next day. So if they open up positive, what does this do? It confirms this signal, and it also tells us that the potential resistance level of the T-line is now not there. We're back up above the T-line ready to go into an uptrend. Technical analysis with candlesticks should be relatively easy for anybody to do. All it is common sense. If they're in a downtrend, where do you think they're going to test to see if it's a support level? Obviously, whatever support level they're heading for, in this case, the 200-day moving average. A bullish engulfing signal right off the 200-day moving average and stochastics in the oversold area is pretty much high probability scenario that they've reversed and they'll continue to take it up further. Once again, a bullish engulfing signal that closes above the T-line, if the evidence is that the T-line is not going to act as resistance anymore, you want to be a buyer. Makes it a very simple trade that if you buy on positive trading, even though it might not close below the halfway point of this candle, if it comes back down and closes below the T-line, you either want to close out the position or be prepared to close out the position the next day if it doesn't open positive and trade positive. Remember, the very simple rule is if you see a candlestick buy signal and a close above the T-line, you should be in an uptrend. That probability is extremely high. That doesn't take care of the fact that some of that probability includes it opens positive and closes back below the T-line. This is a process that, if you've ever heard the sage advice from the wise money managers, that you cut your losses short and let your profits run. But in the 35 years I've been in the business, I've never heard them tell how you cut your losses short and let your profits run. Candlestick analysis does it in a very simple manner. The bullish engulfing signal in combination with the doji is what we call a left-right combination. This is an extremely powerful bullish signal. A left-right combination includes a doji, which is that indecisive jab. Then the next day you have a big bullish engulfing signal, which tells you after that indecisive jab they've come with a big roundhouse right. That's usually going to start your uptrend. In this case, notice that even though it didn't start out right away, it was the stimulus for this uptrend. And as with all candlestick signals, the bigger the signals, the more compelling the reversal is. Notice how you've got a long-legged doji followed by a bullish engulfing signal that closes back up above the T-line, reversing this downtrend, starting your uptrend. Also, you might want to note that a bullish engulfing signal should enclose the body of the previous day, which means it can have one side that is completely or same level as the previous day, but it must exceed the other side. If both of them are the same, that means different has a different ramification as far as what's going on with the long and short positions on that trade. Again, a left-right combination, a doji followed by a bullish engulfing signal, and seeing a little bit of bullish movement or trading the next day confirms that you're probably in an uptrend. Note on the pullback that they're doji type days. You got to remember from your doji training that a doji is indecision. So if you see a strong buy signal with a pullback that is dojis, that's telling you the pullback is very indecisive. Continue to watch for the upside trading move. Left-right combination, strong move. First resistance level pulls back. This is not an uncommon pattern where they come up to the first resistance level, they pull back, but notice where they pull back to. Pull back right here to the T-line. If they can't close it below the T-line, if this is a bullish signal, this is also a bullish signal, which should be expected. Now we've got a strong price move to the upside. Remember, we're just looking for the graphic depiction of what's going on in investor sentiment. If one bullish signal tells you the bulls might be in control, two bullish signals definitely tell you the bulls are in control. A left-right combination in the oversold area implies there's going to be a strong upside. We also have another little signal pattern we call the doji sandwich, which we'll get to later. But the doji sandwich consists of a strong bullish signal and then a day of indecision. But what do we know about dojis? We know the price will move in the direction of how they open it after a doji. So if it opens positive, there's an extremely good probability that this candle right here will be the same magnitude as this candle. This is very effective trading setups for either the day trader that wants to be in and out, or the swing trader that wants to get into a position where they know the probabilities are pretty good, that once they get in, they've already built a profit as far as analyzing what to do with the rest of the trade. A left-right combination, closing right on the T-line, or I'm sorry, the 50-day moving average and the T-line, makes this a very simple entry. If it opens positive and trades positive, you want to be buying. The probabilities after a left-right combination that you will be in an uptrend. The fact that you'll close above the T-line tells you you're probably going to be in an uptrend. The uptrend stays consistent as long as it doesn't close below the T-line, and a pullback, such as a J-hook pattern, can be easily identified as starting back up once they see another left-right combo that has not been able to close below the T-line. An inverted hammer that's almost back to a doji, in this case a gravestone doji, followed by a bullish engulfing signal, still has to be considered a day of indecision, followed by the left-right combo starting your uptrend. And the doji usually is a strong indicator to start watching for the left-right setup. Where do most people sell? They panic sell at the bottom. If you see a doji in the oversold area, we're starting to look for a buy signal. If the buy signal the next day happens to be a bullish engulfing signal, we definitely want to be buying on positive trading. Now, there's a question. Do you buy once you breach the T-line or before the T-line? Well, the most important factor of trading using candlestick signals is the candlestick signal themselves. The probabilities improve if they close above the T-line. However, notice how far away you are from the T-line at this point. The further you move away from the T-line, the higher the probabilities you're going to come back and test it. So the worst case scenario will be you buy on a strong buy. Where should the target be? The T-line. If we see it fail at the T-line, we just come back out of the trade because that tells us we're still in a downtrend. If it goes through the T-line, we know we're in an uptrend until we see a time to come back out of the trade. But the factor should be the signal. Then where is it correlating to the T-line? Always buy based upon the signal. Now the T-line becomes a secondary factor to see whether the trend is going to continue up once it gets there. As we go through these samples, we're going to see there's a lot of reiteration of different points. That's because the more you recognize when these signals occur, the faster you can start reacting to them and improving your probabilities of being in the right trade at the right time and not being in after getting convinced that it's working, which puts you at a higher risk of not making profits with the trade. This case, we see another bullish engulfing signal, starts an uptrend, probably good enough for a trade, pulls back hard on the doji gap down, then a doji left-right combination again, right here at about the same support level, starting the next uptrend. Candlestick signals also have the opportunity to have different descriptions. For example, we've got a left-right combo, a doji followed by a bullish engulfing signal. But this bullish engulfing signal could also be considered an inverted hammer. So bullish confirmation gives you much more or much higher degree of probability that this trade is going in the right direction at the right time based upon a positive open after an inverted hammer, slash left-right combo, and now a close above the T-line. A left-right combination with a bullish engulfing booster signal. The booster being this little tail to the downside, acting like a booster rocket sending things back up. This becomes extremely powerful in the sense that they've wiped out all the sellers, they've reversed it, gone bullish. Now any positive trading the next day you want to be buying. Where's the resistance level? We still need to see it close above the T-line. Once it does, we know we have a good trade. And the bullish engulfing signal acts like a coup d'etat. If you see a flat trading area, if you see a bullish engulfing signal at the end of a flat trading range, that tells you that flat trading range, which was indecisive trading, has now been signaled which direction they would like to take that indecision. Note the gap down trading in an oversold condition. Long-legged doji, a doji, spinning top, followed by a bullish engulfing signal. That tells us that in this indecisive trading, they've now made a decision of which way they're going to go. They gap it up the next day, making the first logical target back up here to the T-line. If it breaches that, we know we have a strong uptrend. But the fact that we see indecisive trading and a bullish engulfing signal is just like the coup d'etat, that all this indecision is now given direction. And to reiterate once again, I guess that's a redundancy. The bigger that signal is, the more the probability you're going to be in an uptrend, especially when you're coming out of a flat trading area. This signifies that there's now been a new change of investor sentiment, and the bigger the signal is, the higher the probability the uptrend is not only going to be an uptrend, but a strong uptrend. But it becomes extremely evident after an indecisive trading range that if you have a bullish left-right combination, that you're going to be for a good strong move after that. So let's revisit some of the bullish enhancements that make a bullish engulfing signal that much stronger. The bigger the signals, the more compelling your uptrend is going to stay in progress. If it bounces off major support levels, like a major moving average, that much more evidence that somebody at those levels is looking to buy. Technical patterns, such as a double bottom, is another added enhancement to show that a bullish engulfing signal after the second bobble here is probably going to start us off on a good strong uptrend. Again, the bigger the signal, the more compelling the uptrend is going to start. Add to the fact that it's supporting off a major support level like the 50-day moving average, and it closes up above the T-line and other aspects. If this was a downward trend channel, if it closed up above that, told us we have a new dynamic in the new price trend. A bullish engulfing signal after a series of indecisive trading. Doji, 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 spinning top, bullish engulfing signal. Close above the T-line, close above the 50 are all indications there's now resistance levels that have been breached, that we've got a new dynamic in the next trend. Also, if you see a booster situation where they've wiped out a lot of the sellers and came back up, that tells you there's less sellers now in the way in this new trend. An indecisive trading day, such as a doji, gravestone doji, inverted hammer, whatever you want to call it, whatever looks like it's going to be an indecisive candlestick signal followed by a bullish engulfing signal, is more evidence that we're in an uptrend. A bullish engulfing signal, again, another left-right combination, part of a morning star signal, all supporting off the 200-day moving average, closing more than halfway up this candle above the 50. Stochastics in the oversold area starting to come up. Now forms a doji day afterwards, which tells us if it opens positive and goes positive the next day, they're going to move it in the direction of how they open it after a doji, that we have another day that should comprise of a strong bullish candle of approximately equal nature of the bullish engulfing signal. This should also lead to further upside after that. This is all common sense put into graphic depiction by knowing what should happen based upon what goes on in investor sentiment time after time, year after year, decade after decade. Investor sentiment does not change. The Japanese rice traders provided us with an opportunity to see what the game plan or the roadmap was that make strong profits using investor sentiment. And a belt hold has significant information built into it, which can be a bullish engulfing signal. Where do most people sell? They panic sell at the bottom. When they gap way down below the previous trading and bring it back up into that trading, that becomes a belt hold. That belt hold can also be developed into a bullish engulfing signal. Essentially, gapping down here told us they took all the sellers out of the way, which should create a strong move after that. Again, after a flat trading phase, a bullish engulfing signal basically tells you what that investment sentiment is going to do after indecisive trading, especially if you find it in the oversold area. Also makes for an easy trade transaction if you see a signal close right on the T-line. If it opens positive the next day, that tells us two things: that they're confirming the signal, and they're telling us the T-line is not acting as resistance anymore. The probabilities are going to be moving in this direction. You set a sell stop by either a close below the T-line or especially a close back below the halfway point of the candle. And the stutter step signal or pattern is a relatively easy pattern to use the bullish engulfing signal to establish your next trade. This chart demonstrates that there was our left-right combo with a gap up, started up, but we also saw a quick sell signal, a long-legged shooting star bearish engulfing signal. Pulls back for a few days, and then we have another left-right combo, starts back up. So if this shows us buying, then the continuation of the downtrend, and then a new buy signal, we want to buy based upon kind of the double bottom or the stutter step. They take it up, pull it back, and then take it back up to the next logical targets. Utilizing the signals and the information built into the signals also dramatically improves the capability of analyzing what a trend is doing. Here's a trend reversal. Stays above the trend until it gets a little soggy. Until when? Until we have another left-right combo closing back up above the T-line. This is now the next time to be buying. A big bullish engulfing signal. Notice after they've closed it above the T-line, they couldn't close it back below the T-line. Made another strong run. Another bullish engulfing signal. There's kind of our attempt to do a Morningstar signal that might not have confirmed. However, a few days later, we do have a signal that's confirming that left-right combination. And what do we want to see for further confirmation? A positive open. And finally, a close above the T-line, telling us we should be in this trade. Now, what does this do as far as getting you into a position early? A lot of people will say, oh, shoot, how can we get in down here? We can't, and we're not trying to. We're trying to take the high probability fat part of a trade until we see a sell signal. We're not trying to buy the absolute bottom. We're not trying to find the absolute top. We're trying to find the trend that told us that the probabilities of being in that trend are great. And then once we see the probabilities start losing their edge, close out the position and find another situation where the probabilities are in our favor. a bullish engulfing signal at the same level the trend turned up before, just that much stronger implication there's going to be a double bottom. We want to buy with the prospect of a good strong uptrend. Why is there a much better prospect of a strong trend coming out of a double bottom? Look at the psychology. If the bears are in a downtrend, they get a little bit nervous when they see the bulls step in. However, the bears from the previous trend can take over, take it back down, but the next move to the upside, the bears are saying, shoot, the bulls are back here again, let me get out of the way, and that's what creates a strong uptrend. And let's address the doji sandwiches again. What benefits they have using the bullish engulfing signal. When the bullish engulfing signal appears, double bottom, gap up, doji, then we have the possibility of doji sandwiches, J-hook patterns. We can use the T-line to start executing or taking advantage of the profits until we see a sell signal. So knowing the simple rules of candlestick signals, that if we have a bullish engulfing signal, we're probably heading up. If we have a doji day, which closes right at the T-line, we know that if it opens positive tomorrow, it's going to move in the direction of how they open it, number one. Number two, it tells us the T-line is not going to act as resistance. Three, it tells us this downtrending channel is not going to act as resistance. And four, the doji sandwich candle is probably going to be equivalent to the candle prior to the doji. Adding all these factors together just puts you into a high probability, high profit trade. The bigger the signal, the deeper the belt hold, the fact that they opened it right on a major support level and immediately started trading in positive are all elements for putting the probabilities in your favor. Seeing a double doji day after a strong bullish candle tells us look for more upside if they open up positive. Using the simple rules applied to each of the major signals allows the candlestick investor to take advantage of what goes on in investor sentiment time after time and be able to profit from that. And here's an area of candlestick analysis that most people do not pay attention to, and that's non-signals. If the signals provide us with information that we know are going to have reoccurring results, there are non-signals that look like buy signals but are not signals. The reason for this is that if the Japanese rice traders had discovered there was any degree of consistency or profitable results, they would have been naming these signals and providing them to us. For example, quite often an uptrend might start because of a bullish looking signal, but it's not actually a signal. In this case, somebody might think this is a belt hold a piercing signal, but it didn't seem to gap down below the previous day's open. But with that knowledge, that tells us there might be some buying, but not sustained buying. That's where you watch for a pullback, and then you watch for your buy signal, making kind of a double bottom and giving you the opportunity to be in the trade that's going to make the profits. Let's do a quick review of some of the characteristics found in a bullish engulfing signal. A bullish engulfing signal after a doji or spinning top is your left-right combo. What do we want to see after that? We want to see the bulls are still participating. Upon seeing a bullish engulfing signal, rules are very simple. Buy on strength. A non-signal can create an uptrend, but not with any great strength. When you see an uptrend starting with a non-signal, start watching for a pullback, and then wait for the next strong signal. A bullish engulfing signal after a pullback basically gives you a stutter step start, which tells you this next move, especially when they gap it up, is going to be a strong move. A bullish engulfing, you can usually confirm a multi-day pattern, such as a morning star signal or a left-right combo, especially if you're down with the stochastics in the oversold condition and you see a buy signal. What's our next resistance? We want to see it get through the T-line. A positive open right at the T-line after a buy signal is probably a fairly safe buy. Stop loss would be it shouldn't close back below the halfway point of the candle that told us the bulls were in control. Bullish engulfing signals also work to tell you what is going on in investor sentiment at important technical levels, such as a support level or a resistance level. Here we have a left-right combo right on the 50-day moving average, creating a J-hook, which we use as one of our patterns in candlestick analysis. A gap up after a bullish engulfing signal indicates a very strong desire to get back into that stock price, which will usually create a strong uptrend. That's the indication that there's going to be a strong bullish movement. What do we expect after a bullish engulfing signal? We want to see bullish confirmation that the bulls are still there. Then watch to see what resistance there might be at your first levels, in this case the T-line, or whether the T-line is now going to be your trend analytic indicator. A bullish engulfing signal seen in the oversold area. Look for bullish confirmation. This is not a difficult process. This is merely the consummation of all the studies and activities or profitability Japanese rice traders utilize the candlestick bullish engulfing signal, knowing that the next day would be bullish confirmation and the continuation of an uptrend. A bullish engulfing signal forming right on a major resistance level, such as the 50-day moving average, it lends that much more credibility to the fact that there's been a change of investor sentiment. A positive trading above the T-line, confirming both the signal and the fact that the T-line is not going to act as resistance, is a major part of the analysis that a new trend is started. And as long as it stays above the T-line, you continue to hold. Will there be nervous days after the uptrend starts? Obviously, because no trend goes straight up. So in a case like this, where it comes back down and does a bearish engulfing signal, got to remember, we've got a bullish engulfing signal in the oversold conditions, stochastics heading up. They took it up through the T-line. There's a buy signal here, especially a double bottom situation. Don't let yourself be scared out by the fact that there's some selling. The worst case scenario will be that it needs to open and start trading positive the next day. If it closed back below the T-line on this day, then you close out the position. But the element of strength came from here, came from the buy signal. That usually gives you the impetus to give it an extra day, give it the let the probabilities work itself out so that you could get ready for the next uptrend. Anytime you see a major candlestick reversal signal, take heed. Something has changed. The Japanese rice traders over the past 400 years established these signals as being something that you want to watch because the probabilities are extremely high there's going to be a change of investor sentiment. Going right back to the basics, if these signals did not work, we would not be looking at them today. The Japanese rice traders that utilized these signals did not only become wealthy, but they became legendarily wealthy using candlestick signals to make their investment decisions. That brings us to an end of our training for the bullish engulfing signal. Please remember that these signals convey quite a bit of information. The Japanese rice traders became legendarily wealthy using these signals to trade one of the most basic of all commodities, rice. The information that is built into each signal allows a candlestick investor not only to visually identify where a reversal might occur, but also understanding the investor sentiment that is causing that reversal. Thank you for listening. I know there was a lot of reiteration on these trainings, but that is for the purpose of understanding and recognizing where your high profitability or high probability, high profit trades can be established. Thank you very much.